Hello, my name is Victor Kalgin, and in this video we are going to consider advantages and disadvantages of tax consolidation, or so-called forming a tax group in the United Arab Emirates. As many of you know, in the United Arab Emirates in 2022, corporate income tax was introduced, and the corporate tax law, allows taxpayers to form a tax group for corporate tax purposes. And this means that two or more companies in the United Arab Emirates can become a single taxpayer. And this decision, this consolidation for tax purposes, has certain advantages. First of all, the companies will calculate their tax base jointly, and they will submit a single tax return as well. And if a company in the tax group has losses and another company has in the group has profits, then these losses can be utilized in the current year against the profits of the other company, which is an obvious advantage of forming a tax group, which allows to reduce current tax burden and utilize tax assets, meaning losses, immediately in the given year. And in addition, intra-group transactions within a tax group are going to be eliminated, which also provides certain advantage and relieves from the burden of from the necessity to have arm's length prices, for example, between the companies that form the tax group. What is the procedure and deadlines for forming a tax group? Well, first of all, a group can be formed, and it is a decision which needs to be made. It's voluntary, and the parent company can submit an application, which is then approved by the subsidiaries, and this is the mechanism how a tax group is formed. Second sense, probably most important, the application must be submitted before the end of the respective tax periods when the tax group is formed, which means that for most companies who have the same financial year as the calendar year, the deadline is approaching. This video is being recorded in December 2024, and by the 31st of December, such companies which have the same financial year as the calendar year need to submit an application to form a tax group, which means that there is not much time to make the final decision and submit an application. There are conditions that need to be made, conditions which need to be met, and limitations of forming a tax group. First of all, there is a participation threshold. Companies, the parent company, have to have a direct or indirect shareholding, participating interest of at least 95% in the capital of the subsidiaries that form the tax group with the parent company. And in addition, the same threshold applies to the voting rights as well as to the rights to receive dividends and liquidation proceeds from the subsidiaries. So 95% is a strict condition to have to be met to apply to form a tax group. Second, also important, companies that are qualified residents of free trade zones, they are not able to join a tax group, which means that those companies that do not pay corporate income tax, or pay corporate income tax at a rate of 0%, they are not able to be part of a tax group. And there are other requirements. For example, the companies in the group should have the same financial year and have to have uniform accounting, to use the uniform accounting standards. So let's consider a couple of examples. On the slides, you see that there is a parent company in the United Arab Emirates, which have two subsidiaries also in the United Arab Emirates. And as long as the 95%, as long as the 95% threshold is met, then these companies should have the possibility to, as well as other conditions, these companies can form a tax group, or they may decide that only the parent company and one of the subsidiaries form a tax group and the other subsidiary does not join. This is also possible. But if two companies in the United Arab Emirates, they are owned by a company which is not a company in the United Arab Emirates, there is no parent company, there is no domestic parent company in the United Arab Emirates, then they are not able to join the tax group. There is a requirement to have a domestic parent company, otherwise, and even if there is a parent company in the United Arab Emirates, but it is a resident of a free trade zone, the tax group cannot be formed either, which is sometimes restrictive. So on the surface, there are two affiliated companies, two subsidiaries. They are parts of the same group, but they cannot join the group, the tax group in the United Arab Emirates, because there is no single parent company in the United Arab Emirates which qualifies for the condition to be a parent company of the group. There are disadvantages which are closely linked to the principle that several companies start to calculate their tax base jointly. First of all, there is a threshold of 375 dirhams to which the 0% rate applies, and before the consolidation, each company applied this threshold individually, and as many companies as you have, each of them can enjoy the benefits of having the first amount of profits of 375 dirhams not being taxed, not being subject to corporate income tax in the United Arab Emirates. After the consolidation, this threshold will only apply once. It is not multiplied by the number of companies, which will limit the application and may increase the tax burden. Second, there is a small business relief, and again, it's tested on individual level before the consolidation. After companies consolidate, obviously their revenue increase, and they may exceed the threshold of 3 million dirhams and may not be able to enjoy the tax consolidation. And finally, and in some situations, and maybe most important, there is also a thin cap limit which is applied individually, and if interest is not deductible due to application of thin capitalization rules, then after the consolidation, these companies are will be required to apply these limits jointly, and this may all of a sudden make some interest expense non-deductible, because it will not be applied, it will not be multiplied by the number of companies, obviously. Which means that in certain cases, it is either impossible or impractical to form a tax group. And in such situation, there is a simpler alternative which may be considered, which has a very similar tax effects. And the alternative is called transfer of tax losses. It is possible, instead of consolidation, to consider transferring tax losses between two companies in the United Arab Emirates, and the conditions are less strict. If one company is profitable and the other is loss-making, then the loss-making company, as long as there is a participation threshold of 75% is exceeded, and other conditions are met, the losses can be transferred to the profitable company. And obviously, the participation threshold is lower. 75% is less than 95%, and sometimes it may be more important that it is possible to transfer of losses between sister companies, between subsidiaries of the same foreign parent company. In this case, there is no requirement to have a domestic parent company to transfer losses between two subsidiaries. And the foreign parent company can meet the shareholding threshold. There are some similar conditions. Qualifying residents of free trade zones are not able to transfer losses, and the same financial year condition also applies as well. Other instances where tax consolidation is more advantageous compared to transfer of losses. Well, we can consider a situation where before the consolidation, each company jointly, some company has losses that are not deductible for tax purposes. And probably an obvious example would be where this company uses loan to acquire an operating subsidiary, and interest on this loan cannot be deducted, for example, due to capitalization limitations in the United Arab Emirates, or because there is no taxable income at the level of the parent company. In both these cases, if this interest is not deducted due to capitalization rules, then it would be better to consolidate the two companies to have this interest expense being deducted against the current profits of the operating company. So in situations of so-called leveraged buyout, a mismatch of income and expenses leads to a situation where tax consolidation provides an advantage, tax saving effect effectively. Okay, three conclusions from what we've just discussed. Tax consolidation or forming a tax group in the United Arab Emirates has its advantages, including simplified reporting, consolidation of income and expenses, and elimination of intergroup transactions. There are disadvantages, however, which in some situations call for reconsideration of another possibilities, and the simple alternative would be to transfer tax losses between two companies, because the conditions are less strict. There are instances where it is easier, and moreover, there is no time pressure, because transfer of tax losses, they do not require an application before the end of the tax periods where transfer occurs. It can be done later in a tax return. So the final decision for 2024 needs to be made before the year ends, and so there is little time. This video is being recorded in December 2024, so keep this in mind, and you still have time, if you're watching this video in December, still have time to make the final decision, and you need to weigh all pros and cons and compare advantages and disadvantages of tax consolidation or forming a tax group in the United Arab Emirates. And finally, I'm never tired of saying that each situation is unique, and it needs to be considered based on all relevant facts and circumstances. And this is what we do with our team. We help our clients and advise them to plan their taxes and avoid tax inefficiencies, especially in international structures. This is what we do. Contact details of some of my team members are on the slides, and in the description to the video you will find a link to the presentation where you can also look up for our contact details. So let's keep in touch, and thank you for your attention. Thank you, and bye.